Everyone, welcome to our webinar on carbon accounting. And today we're going to talk through how to build a reliable GHG inventory. I'm just going to wait 1 or 2 minutes while everyone kind of joins the room. Welcome everyone in. Really nice to see lots of you joining this morning. This is the first webinar in our carbon accounting series, so we're really excited to talk through carbon accounting, the GHG Protocol, Scope 1 to 3 emissions, and hopefully give you a bit more clarity in this research area. I'm Freddie. I'm a sustainability researcher here at CoolSet, and here with my colleague Jasper, who's also a sustainability researcher, and we've both been working on carbon for quite some time now. So I hope to be able to share our knowledge with you all and give you a bit more insight on carbon and the GHG. So I think a few more people are joining the room, but then we can get started. Very happy to be sharing a new topic and moving on, diversifying. We've done a lot of EUDR recently and EcoVadis. So now nice to kind of move on to a new topic and share this with you all. But I think we can get started. So a small agenda for today. We're going to start by introducing you to what is carbon accounting and the GHG protocol that it depends on. And then we'll get you started. So just how to begin this whole process if you haven't gone through any of it before. What are the beginning steps and how do you set up your company for success? And then Jasper will talk you through how to calculate the emissions and different strategies to do so. That's spend-based and activity-based emission calculations. And then we're going to run you through a case study, so a really practical example, putting all this into work and how you can see how it works in practice and in operation. And then we're going to zoom out again and show you how carbon accounting connects with bigger picture frameworks and regulations and why they all intersect. And it's really important to draw this together. And then we'll do a quick brief talk over how CoolSet can help. And then finally, we'll end with a Q&A. So throughout the webinar, if you have any questions, feel free to put them in the bottom right in the question tab, and we'll get to them at the end. Let's get started. So to start, what is carbon accounting? It's a method used to measure, track, and report greenhouse gas emissions for an organization or product, event, or person. So essentially, it's like financial accounting, but for your emissions. So it's taking stock of all the emissions your company is responsible for. And the golden standard for carbon accounting is the Greenhouse Gas Protocol, which provides a standardized calculation framework, which the majority of companies and businesses worldwide depend on to do their carbon accounting. And as we said, the goal of carbon accounting is to measure, manage, and reduce your GHGs over time. So I think the end goal is kind of that net zero or emission reduction. But obviously, to be able to reduce, you've got to start by measuring and knowing where you're at today. And that's what we're going to focus on. Next slide, please. Great. And why do we do carbon accounting? So as I just said, sustainability and climate goals are one of the main drivers, with the EU aiming for net zero at 2050, and maybe your company has their own net zero goals. This is a really great place to start with reducing those emissions. But also carbon accounting connects with regulatory and other framework compliance, such as CSRD, SBTi, and EcoVadis. And we're going to go into this in a bit more depth later to show you exactly how they connect and how starting with carbon accounting can set you up for success within these frameworks later. But that'll come. And investor and customer appeal is a big driver for doing carbon accounting, because in the industry at the moment, there's growing demand for transparency and strong ESG performance. So doing carbon accounting and sharing that with customers, either clients or other businesses, can really have a positive impact on your business goals. And finally, cost savings and inefficiency reduction. So by doing carbon accounting and taking stock of where your highest emitting areas are, you can start to make improve efficiency, because you can make reductions, both reducing the emissions from that area, but also costs. So it's a win-win opportunity there. And the GHG protocol. So as I said earlier, the GHG protocol is the kind of golden standard for carbon accounting. So it's what most companies use, businesses, governments, and NGOs, to understand, quantify, and measure greenhouse gases. And it was developed by the World Resources Institute and the World Business Council for Sustainable Development. So it's a globally used and recognized standard. So that's kind of really helpful for consistency across the world and comparability. And it provides a comprehensive and standardized approach to carbon accounting, dividing emissions into 3 scopes, which allow for deeper introspection into where your emissions are coming from and therefore reducing them. And as we can see here, 92% of Fortune 500 companies use the GHG Protocol. That statistic is from almost 10 years ago, so we can only assume that's gone up significantly in the recent years. And scope 1 to 3. So the GHG Protocol categorizes emissions into 3 scopes. And these scopes, as I said, divide and kind of give more introspection into where your business emissions are coming from. So scope 1 is the direct emissions from owned or controlled sources. So that's any fuel you're burning on site, maybe if you're in a manufacturing industry, gas to burn and heat products, and then also fuel for cars that your company owns or controls, so diesel and petrol. And that's generally a pretty small proportion, around 10% of a company's emissions. Scope 2 is the indirect emissions from purchased energy, so electricity, steam for heating and cooling, but again, that purchased energy that you bring to your company. Again, pretty small, around 10% on average for most companies, often smaller if a tech or small office company. And finally, we have scope 3, which is all other indirect emissions, both up and down your value chain. And this generally accounts for between 65 and 95% of your emissions. But this includes absolutely everything else. So purchased goods, capital goods, so buying new machinery, new products. It accounts for transport up and down the supply chain. And yeah, as we say, that accounts for most of the emissions. So I think Apple reported about 98% of their emissions are scope 3. So you can see that really a lot of the emissions are concentrated here. And the Greenhouse Gas Protocol provides 15 scope 3 categories, allowing a company to map exactly where within scope 3 these emissions are coming from. And performing a scope 3 screening can really help here, ensuring that nothing is overlooked. So on the right, we can see categories 1 to 8 are the upstream emission, scope 3 emissions, which includes purchased goods, waste generated in operations, and business travel. And then 9 to 15 is downstream. So once the goods or services have left your company, controlled, maybe delivering goods to customers, or once a good has been used, that end of life process of recycling or waste disposal, etc. Now we're going to get started with how you begin with carbon accounting. So I've given you a bit of background, but now how exactly do you start to calculate your own scope 1 to 3 emissions? So first, we're going to talk about defining your organizational boundary and exactly what that means, choosing a base year and why this is important, gathering data, and then going through this scope 3 screening that I just talked about. Great. So defining boundaries. The GHG Protocol allows for 3 boundary approaches. So a boundary is what you're going to report on as your business. So what counts as your business? The first one is operational control. So you account for any emissions that your operation manages day to day. So all the emissions that come from areas of your business that you operationally are in control of. Financial control is another consolidation approach, and that's accounting for 100% of emissions from entities you control through financial means, majority ownership or veto rights. So not necessarily managing on the ground day to day, but financially you have control. And finally, the equity share approach. So this is proportional to your ownership stake, so how much you control. And choosing one of these boundaries is really important because it will set the scope of your GHG emission reporting, and it should be chosen consistent with any other reporting goals you have, so CSRD, SBTi, So it's important here to kind of discuss this with your wider team, maybe your financial or legal team, ensure it's consistent across the business. Next slide, please. Here we can see an image which kind of depicts this a bit clearer, but we can see at the top, we have the equity share, then financial and operational control. And for example, under operational control, so that's the bottom line, a company is in control of both the main office and the subsidiary. So say it's a factory, they day-to-day run the operations of both the main office and the subsidiary. Therefore, the emissions from the main office and subsidiary follow under scope 1 and 2. And the partner, they don't have operational control over, so the partner controls their own operations, but because the partner's emissions will contribute to the supply chain, they count as scope 3 emissions. Whereas in financial control, the partner and the subsidiary count as scope 3 because a company only has financial control over the main office, but neither the subsidiary or the partner. So it shows how these different boundaries affect where emissions are captured, and therefore your total kind of emissions calculations and carbon accounting. Great. The next step is choosing a base year. So the GHG Protocol recommends a fixed base year, for example, choosing 2022 for consistent tracking. This base year will be your foundation for comparison as you go forward. So choosing a base year, the earliest year with complete and reliable data for all significant emission sources is important, because in 10 years, for example, if you chose 2024, you can then depict how your emissions have changed, hopefully reduced from that base year. It's important at this point also to establish a recalculation policy to ensure comparability. So if in a few years' time you have major acquisitions or divestments, maybe you have a methodology update or significant data errors are discovered, you should also then recalculate your base year to ensure that what you're comparing from and to is comparable in terms of scope and data that you're using. So yeah, establishing the policy and establishing the base year at the same time will set you up for consistent success in the future. And these recalculations are also required by other frameworks such as SBTi. Gathering data is the next step. So we've just determined the scope you're going to report on and also where you're going to start reporting from. So start now assembling data for each scope. Scope 1 is the easiest one to start with, and that's the direct emissions. So here you might gather fuel purchase records, maybe meters cubed of gas used, petrol receipts for vans or cars your company owns, there's petrol and diesel receipts, and that can start to cover scope 1. Then you proceed with scope 2, the indirect emissions. So here, looking at your company electricity bills will be one of the main tellers. Any kind of cooling, heating bills that you use in your company, this is more likely to be true for hospitality or manufacturing. If you're kind of an office or a tech startup or something, you might just have electricity bills for heating and lighting your office. And finally, scope 3, so that's everything else. So everything from purchased goods and services to employee commuting. And this will include both financial and activity-based data likely, and is the hardest to calculate. We recommend here again kind of getting buy-in from stakeholders, starting with your financial records. So where does most of your money go to, your largest ledgers and vendors, and start mapping there, but also getting buy-in across the company to determine your biggest areas. If we move on, we can see that a scope 3 screening will help here. So a scope 3 screening is when you use the 15 GHG Protocol categories to identify all upstream and downstream emission sources. So it's using that list I showed before with the 15 categories to identify where you might have material emissions. So for each category, you can assess the relevance and materiality based on spend, volume, risk, and influence. So if you're a retail company and you're buying clothes, for example, it's likely you're going to have a lot of emissions in purchased goods and also transport, but maybe fewer emissions in employee commuting if it's kind of all remote workers, for example. Collaborating here with relevant stakeholders to support the screening process is really important. So that's both internal but also external suppliers, vendors, customers can be really helpful to get spend-based data, but also activity-based data if that can be accessible. And finally, documenting exclusions and rationale to meet transparency requirements under ESRS E1 and SBTi is important. So if you decide one of the 15 categories is not material to your business, maybe you have no employees apart from yourself or no one commutes, then it's important to document why you believe this and your rationale. So if complying or using this information in a framework later on, you have that evidence. Great. Now we have a poll just to kind of understand where you all are in your carbon accounting journey. So just asking, how are you currently approaching carbon reporting? Do you use internal tools and spreadsheets? Maybe you're doing it on Excel, or are you using a dedicated carbon accounting solution? Maybe you're actively looking for a solution right now, or you're not considering anything at the moment. Let's see where the results are coming in. You can see about 50% are using internal tools and spreadsheets, with just over 30% are using a dedicated tool or solution, and around 15% are looking for a solution. So kind of a mix between there. A couple of you not considering it just yet, but maybe this is a good start to starting that journey off. But that's great. Thanks. Moving on. I'm going to pass over to Jasper now, who will tell you how exactly you can begin with calculating carbon emissions.
Perfect. Thanks, Freddie. Yeah, so hopefully now that we have a good understanding of how carbon emissions work, we can get a bit more practical and kind of break it down for you so that you also understand by the end of this session, hopefully, how to do a carbon assessment by yourself and kind of what the details are that you need to consider going forward. So when you calculate your emissions, there are two main methods to always consider. And these are the spend-based method, which is essentially where you use financial cost or purchases using emission factors based on currencies like the euro or the dollar. And then there's the activity-based method, where you use activity usage data, i.e. physical quantities, using emission factors based on kilograms, kilometers, or tons. So the key difference here is that the one relies on financial data and the other relies on activity data, which you can get from various sources, like, for example, company fuel cards, but more about that in a second. What we see mostly, for example, at Coolset, is companies using the hybrid approach, essentially combining both together, because that kind of provides the perfect balance between granularity, which is more activity-based, and coverage, which is more spend-based. So we're going to dive a bit deeper into that and give you some examples to work with. But first, let's have a look at what an emission factor actually is, which kind of forms the basis of the calculation element of carbon accounting. Quick definition here, an emission factor is a number that converts real-world data, either spend or activity, into emissions. It's as simple as that. And the formula that we always use for this, it doesn't matter how kind of complicated the emissions behind it are, but the formula is activity data multiplied by emission factor equals emissions in kilograms of CO2 equivalent. That's more or less always the default formula that you're going to see. And then some examples of actual emission factors are, for example, electricity. You would, for example, say, well, based on the Dutch electricity grid, and then having a mix of all, a mix of the average grid. So say let's say 20% coal, 30% gas, 20% wind, and so forth. That would give you an emission factor of 0.35 kilograms of CO2 equivalent per kilowatt hour of consumed electricity. So if you have an overview of all of your electricity consumption in 1 month, say it's 5,000 kilowatt hours, you would multiply that with this emission factor, and you would get a number of you would get an emission number that you can then apply to your electricity usage for that month. Same applies to the other emission factors here. So fuel, for example, we would say that has an emission factor of 2.68 kilograms of CO2 equivalent, in this case per liter diesel. So that's the unit here. For flights, you might then say, well, we start with spend-based, so that could be 0.25 kilograms of CO2 equivalent per euro spent. But of course, here's a good example of where you could say we start with spend-based, and then we start mapping our flight data on a more activity-based manner. So either you get the data from the flight company that tells you how much kerosene is attributed to your trip, and you can do that in a standardized manner so that all of your employees can basically track that, and you can register that in the carbon accounting platform. Or you just go one step before and you say, well, I flew from Amsterdam to Berlin, which is around 600 kilometers, and that then gives a certain emission factor based on kilometers instead of on euros. Then the last emission factor here is also spend-based, so that's office supplies, 0.5 kilogram of CO2 per euro spent. And essentially, what's also good to note here is that the difference between the two also is essentially that spend-based emission factors are a bit more susceptible to changes in the market. Because, for example, if an emission factor that is spend-based comes from 2023, and in the meantime there's been a lot of inflation, then basically the relative emissions are going to rise with that inflation, because the price you pay is no longer relevant to the price that was used to calculate that emission factor in 2023. So that's just a bit of a kind of something to think about, that when you use emission factors, it's always good to use the most recent version, and also a good reason to stick to activity-based because it's less susceptible to changes in the market. Essentially the formula for an emission factor, therefore, is always kind of x kilograms of CO2 equivalent per unit. And that unit can be euros, it can be diesel, it can be kilometers, it can be a lot of things, but that's essentially the way to calculate these things. Also interesting to note is, where do these emission factors come from? So for example, in the CoolSat database, we have over 15,000 spend-based emission factors, and it is interesting to know where they come from. So essentially where they all are calculated, or the methodology for it, is called, it's a bit of a tongue twister, but it's the environmentally extended multi-regional input-output models. And in short, they're called the EEMRIO models. And they're based on three things that actually are combined. So on the one hand, you have the input-output tables, and these show how industries trade goods and services. So this is kind of an economics exercise based on very large models. Then you add the multi-regional links, where economies will, for which links economies worldwide to capture global supply chains. And then the last step is to add the environmentally extended, which adds greenhouse gas data to each sector's output. And essentially what you then get is an emission factor, because it basically calculates total sector emissions divided by total sector output, which is then kilograms of CO2 equivalent per euro. I know that this is quite a fast rundown of how to calculate it, but I just wanted to give you a brief explainer. If you want to know more, we're happy to send you some articles to get you started. But essentially, it's based on these big economic models that are calculated annually for different organizations. Predominantly in the UK, US, there's some in Germany. The Netherlands has a database, but that's also a bit of an indication for you that emission factors are not always as readily available as you might hope. So it's also kind of looking for the closest relatable emission factor and using that in your calculations, which is also to say that carbon accounting is sometimes more of a very good guess than an actual output. And that is also what the experts say. So an expert will never say we calculated the exact emissions. They will always say we kind of calculated the estimate of your emissions. So let's have a look at spend-based calculations. How does it work? So the formula here is very similar to what we just looked at, but here specifically looking at euro spent. Can also be dollar spent, can also be any other currency. But most emission factors, for example, in the CoolSat database, are based on either euros, pounds, or dollars. And of course, you can also convert that using currency exchanges. But then you also have to consider, it gets a bit more complicated, when was that emission factor created? And do we then use a currency exchange from that period, or do we use one from this period? Because you are also using something, for example, if you buy a car now and you run it through a carbon assessment, that car can also be converted into pounds in current time. So it's just a bit of a complicated sidestep that you have to make when you convert emission factors, but something to keep in mind, and also something that's automated when you work with a carbon software such as CoolSat. So where is the data sourced from? Well, in this case, it's sourced from financial accounting records. So for example, if you want to calculate your carbon footprint for the year 2024, you would provide all of your financial data for that year, and then you would include only the relevant ledgers in this case. So for example, ledgers like salaries and taxes and intercompany transactions wouldn't be included in carbon accounting, but ledgers like company purchases, vehicle fuel, consulting costs, all of these things that kind of contribute to your company's footprint, either financial or emissions, will of course be contributing. Spend-based is a good starting point for Scope 3 categories like travel, purchased goods, and services. And here, a quick example is, for example, that a company spends 10,000 euros on t-shirts as part of a promotion campaign, and you find an emission factor for textile or for specifically t-shirts that says that €1 of t-shirt expenditures is 0.5 kilograms of CO2 equivalent. You multiply those, and then for those 10,000 euros on t-shirts, you get an emission output of 5,000 kilograms of CO2 equivalent. Yeah, that's essentially how simple it is, or how simple it can be. Of course, you do have to also find the emission factor, which can, I think, be the hardest part here. But that's pretty straightforward. Then good to know that it's best for quick baselining, identifying hotspots. So it's a really good starting point. And the tip here is that accuracy depends on your financial data quality. So if you have very high level data quality, or for example, you don't have any descriptions, or the ledgers are really, really badly described, then that will also kind of set the tone for the output of your emission calculations. Another slide here on activity-based calculations, quite similar to the one before, just a bit more nuanced on what kind of data you're using. So here the calculation or the formula is essentially very similar, just instead of euros, they're using activity data. And the data is usually pulled from various sources, like, for example, fuel cards or your electricity bill. But for example, we're also working with various companies that are working with LCA suppliers, or that are asking their suppliers for supplier-specific emissions. And that, for example, we know that DHL, the transport, the shipping company for packages and letters, they provide a service where every product is directly linked to an emission output, and you have, for example, a CO2 dashboard that you can use. So we're seeing more and more suppliers offering this, which then allows you to provide supplier-specific emissions for that vendor, which is really interesting. Also good to note here is that activity-based calculations are really good for Scope 1, Scope 2, and key Scope 3 categories like fuel use, electricity, logistics, and waste. And a quick example here could be that you use 2,000 liters of gasoline, multiply that with an emission factor of 2.68 kilograms of CO2 equivalent per liter, and that gives you an output of 5,360 kilograms of CO2 equivalent. Activity-based, therefore, is best for accurate auditable reporting and tracking reductions over time. And the tip here is to use reliable emission factors because they're not always as easy to find. Yeah, I've spent many hours over the last couple of years looking for emission factors when a customer had a very specific kind of database or very specific request. And then you sometimes have to look kind of deep into these academic papers that wrote LCAs, or you have to look into these databases. Some databases are also behind the paywall, so it's not always as straightforward, but it is getting better and better. So yeah, if you have questions about where to find emission factors, also happy to help there. When to use each approach, I think it's already quite clear, but essentially spend-based is ideal for first footprint, broad coverage, and low effort, so kind of a hotspot analysis. And activity-based is better for it's ideal for mature data systems and has higher precision, of course. You should combine both for scalable, creditable reporting. I think there are very few companies, if any at all, that base everything on activity-based data, because, for example, if you spend 50,000 euros on consultants, I think that will be very hard to quantify as an activity-based emission factor. I think that's in the current day and age of carbon accounting just simply not possible yet. So there will always be some things that are referred to spend-based calculations. And my tip there is start with 80-20. So 80% spend-based for coverage and then 20% activity-based where data exists, as it also kind of is good practice to get you started. Okay, where can we improve the data quality? And helps your company set up kind of a process for that. Getting started, so start broad, refine as data matures. Spend-based gives coverage, activity-based gives confidence. Update emission factors annually if you do it yourself, and keep records to support audits and future recalculations, especially, for example, if you want to work with something like EcoVadis, SBTi, or CSRD, which we'll cover in a second. You need to have greenhouse gas accounting systems that are auditable. And as mentioned already, activity data enables granular decarbonization, as you can really dive into the details and say, well, okay, if we switch from virgin plastic to recycled plastic, then we can switch emission factors, which gives us a lower emission output. Now we move on to a case study, so make it a bit more practical. For those that perhaps have been part of the UDR winter school that we kicked off yesterday, you'll recognize this company. We are going to look at Canal Chocolate BV. BV standing for kind of a Dutch company type, and we'll have a look at how they calculate their carbon emissions and where they focus their time. So to give a bit of an overview before we dive into their specific emissions, Canal Chocolate is a small chocolate company who have a factory just outside of Amsterdam, and investors have requested a 2024 greenhouse gas emissions data for their annual report. They import cocoa beans from Rotterdam, from the harbor, and they make chocolate bars in the local factory and deliver bars around Amsterdam using a company van. And they have around 20 employees, most of whom work in the factory with a couple working remotely. So that's a bit of a background on the company itself. Now let's look at what that actually entails. So the first step here is to define the boundaries of your emissions report. And you'll see that if you go into, for example, the Greenhouse Gas Protocol report on setting boundaries, you'll find dozens of pages on how to do this. So it's not always as straightforward, but essentially the decision is yours. So there's 3 options. And basically starting with the premise that Canal Chocolate, they have a small shop and a franchise in Germany. And the organizational boundary is as follows. So you either have the operational control, which then would include the German shop. So that is if Canal Chocolate sets its policy and manages its operations. Under financial control, if you choose that approach, you include the shop only if Canal Chocolate consolidates its financial accounts. So if it also accounts for the franchise. And then you have equity control, which would then exclude the shop unless Canal Chocolate owns a proportional equity stake. So that's kind of, that's how to do it. That's how to approach this part. In our case, the Canal Chocolate uses operational boundaries, mapping scope 1 and 3 in that context. So they would include the shop, and they set 2024 as a base year, as that is the first full year of available data. Then for step 2, they start mapping their activities. So here we just took some examples that kind of make it clear, okay, how do you do it? Where do you start? So for scope 1, they look at direct combustion, which comes from emissions from owned or leased vehicles in this case. So for example, if they drive their vehicles from the harbor in Rotterdam to their factory close to Amsterdam, those emissions, if they are owned by the company, are linked to scope 1. And the data source here would be then, for example, liters of fuel from the fuel card system. For scope 2, you would of course look at electricity use. So this is purchased electricity for lighting, heating, and cooling. And this would be, for example, kilowatt hours from energy bills or smart meters. And we're seeing that the top 2, so what I just explained, is almost always available by companies. So most of our customers have this data available. Sometimes they have to ask around or they have to look into their system, but this data is usually there. Then they also look at scope 3, category 1, which is purchased goods and services. And here the description would be emissions from suppliers producing purchased materials. And the data source would be euros spent on raw materials from accounting data. So say, for example, they spent 500,000 euros on chocolate in 2024, then they would have a spend-based emission factor for that chocolate. And then, of course, in the next years, they would refine that emission factor. Scope 3, category 6 is business travel. There they look at flights, trains, hotels booked for employees. And then, for example, the data source might be flight distance, as I mentioned, or euros from travel booking systems. And then for scope 3, category 11, which is use of sold products, which is a bit more technical in the calculation, but also very doable. There they look at energy consumption during customer use phase. And there, for example, would look at estimated kilowatt hours per product multiplied by units sold. Now, this wouldn't directly be very quick, obviously applicable to a company that sells chocolate, but it is useful to consider that this is also something to, for example, account for when you're working with products that customers use by using energy. So, for example, if Freddie mentioned Apple as an example. The reason why Apple has such a high scope 3 is because in their use of sold products, whenever they sell an iPhone under the Greenhouse Gas Protocol, they also need to account for the life cycle emissions of that iPhone. So, for example, I've had my iPhone now for over 5 years, and they basically have to estimate that I, as a user, will use that iPhone, will charge my phone in that period maybe 10,000 times. And that also means that every charge basically uses electricity, and that is part of Apple's emissions. So that is a very high level assessment on my end, but basically that is something to consider. So there it gets a bit more technical, but not for today's session, but to give a bit of context, should you be doing that. Step 3, here it gets more practical. So here we look at the actual data input. So for example, we have some ledgers, which are financial data categories. So here we're looking, for example, at propane fuel for gas furnacing, which is scope 1, and they, for example, have 500 liters. I won't go through all of these, but just to give you some example, here the 4th one from the top is purchased goods. So for example, cacao, sugar, milk powder, packaging, etc. This is scope 3.1, and here they spend 83,000 euros. And then for the last one, they might say we did apply commuting calculations. That's scope 3.7, and we have a 2,200 kilometers traveled. Of course, here, for example, the Coolson platform, you can break that down by transportation method. So you could say 20% came by train, 40% comes by car, another 10% walks, and then we have the X percentage that remains that comes by public transport or carpools, for example. So there's different options to consider here. Step 4, of course, is then calculating your emissions. So we have 3 spend-based and 2 activity-based calculations here. So for example, as we already mentioned, office supplies is one example with an emission factor of 0.5 kilograms of CO2 equivalent per euro. Then they spend 10,000 euros on that. So the result is 5,000 kilograms. I don't think we need to go through all of these examples, as I think it's pretty straightforward. Good to note is that we will share the slides with you at the end of the webinar, so you can look through this in your own time and kind of use it as a basis for your own starting point. And then for step 5, quality control, you need to be consistent in choosing emission factors, first by country, then by year. It's kind of the rule we use at CoolSet. You need to use trusted sources like BEIS or DEFRA, which are both from the UK, or CO2 Emissiefactoren, which is a Dutch organization, as you might have heard from the way I pronounced it. You need to keep a clear trail of every number and source for audits. And when you find better data, you need to update and improve, because transparency is better than perfection. And as your data grows, let tech do the heavy lifting, which means automating uploads, emission factor updates, and checks. Quick roundup, Canal Chocolate applied operational control instead of 2024 as a baseline. They calculated spend and activity-based emissions, and the next steps are to consolidate financial data, substitute spend-based data with more accurate activity-based data, and integrate automations for data updates. Now, a quick overview of leveraging scope 1, 2, and 3, which is a bit more in the context of why companies do this. So we have this overview. Basically, that's the business case. So on the one hand, you have regulatory pressures from CSRD. CSRD requires companies to measure their scope 3 emissions as well as scope 1 and 2. Also, CBAM here is interesting. So it's the Carbon Border Adjustment Mechanism. You also have sustainability goals in general. So companies want to reach net zero, for example, or they just want to decarbonize. You have cost savings, which are linked to reducing inefficiencies. So it's surprising how many conversations I've had with customers that have started kind of this boardroom level conversation about calculating scope 3, and in that process realize, oh, actually, if we just switch to a new vendor, we're not only reducing our output, but we're also being more sustainable. Then another point is investor and supply chain pressure, which essentially links to the fact that SBTi and EcoVadis are good starting points for that. And then RFPs are some things that you could use there. Regulatory compliance. Let's have a quick look at what that means specifically. So as I mentioned, CSRD and ESRS E1 have mandatory disclosure of scope 1 to 3 emissions, reduction targets, and transition plans. For those that are keeping track of the ESRS updates and CSRD updates as part of Omnibus, these are likely to be updated, but we do expect that scope 3 will remain part of ESRS E1. Then there's other frameworks like GRI 305, ISSB S2, and EU taxonomy, which all rely on accurate greenhouse gas data. There's also the market-driven case. So we see that supply chain pressure is really becoming a big thing. So many large buyers expect EcoVadis and or SBTi alignment, customer preference. So a lot of customers these days consider low carbon products and transparency very important. Anyone that's kind of been bombarded with ads in the last year will know that kind of a lot of companies now integrate sustainability as a core part of their business model, and that has to do with the way customers choose their products. And carbon accounting is a big part of that, because if you want to state that you're doing something, you need to often in these reports mention your emissions. And of course, also reputation and access. So verified emissions open doors to green finance and preferred supplier lists. For cost efficiency, we also see that there's efficiency gains to be made. So emissions mapping reveals energy waste, transport inefficiencies, and process losses, and lower operating costs. So reducing fuel and electricity cuts CO2, but also spend. And I think that's also often an argument that's forgotten, that reducing certain kind of resource flows is also a direct benefit for your financial flows. And of course, resilience. So anticipating carbon taxes and energy price volatility is a good way of doing business. Now, a quick poll before we get to the Q&A in a second. I'm seeing a lot of interesting questions coming in. Let me put it live for you here. So what is the main reason you would invest in carbon accounting? Regulation, market forces, other, or still not considering it? Okay, seeing right now 64% saying that it's market forces, 25% saying it's regulations, 16% saying other, and no one's not considering it. So I think for the people here, I mean, I guess it makes sense that most of you have considered it one way or another. And I think it's also kind of an interesting sign of the times that market forces comes out at the top, just because when looking at Brussels, a lot has changed in the last months regarding the regulations, and kind of the market has taken over as the main incentive for companies to report, as seen from my perspective. But interesting, good to know. Now, just a very quick overview of what we offer at Coolset before we go on to the Q&A. I'll just spend 1 or 2 minutes on this just to give you a bit of an overview of what we offer. So introducing Coolset, we are an ESG and supply chain platform for compliance-first teams, and we're founded in 2021. And we have one platform to support your complete ESG and compliance journey, including ESG, compliance, of course, carbon management, topic of today, and supply chain integrity. So what do we do for carbon compliance? So we have basically within weeks, you achieve complete compliant results, and you can generate effortless, expert validated, and TÜV certified measurements. So every kind of report that you generate in Coolset is certified. We identify top emitting vendors, locations, and business units, and you can model SBTi aligned reduction scenarios and monitor year-over-year progress. You can use our hybrid model for full coverage and detail. So you use activity-based data like volumes of materials and supplier-specific information where available. And of course, you import spend data to fill the gaps and ensure full coverage of scope 1 to 3. And you can drill down into your emissions and plan reductions. So you can compare data on company, business units, and supplier level. You can plan and model reduction targets to track year-on-year progress, and you can directly export and share validated results and reports. So that was it. Now we have some minutes for the Q&A. I just had a very brief look, and I've seen a lot of questions coming in, so that's nice to see. I will start here at the bottom. Got a question here from Jojo. When should you go back and recalculate your company's base year instead of sticking with the original one? Good question. So essentially, when companies notice that there's, for example, more than 5% of emissions based on recalculation. So if you were to say we change our methodology, or we got a whole new way of calculating. So we switch from financial to equity share approach, and it leads to a change of more than 5% of total emissions. That would require a recalculation of your emissions. I'm going to have a look at the more upvoted questions just because I want to be aware of everyone's time. So I have a question here with 2 upvotes from Caroline. When assessing scope 3 categories using a spend-based method, what is the best way to justify the materiality threshold applied? That is a good question, and also very context dependent. So the materiality threshold essentially allows you to exclude emissions that fall below a certain threshold. I don't remember the exact materiality threshold. I'd have to look again in the Greenhouse Gas Protocol report. I recently looked into this, but essentially it allows you to look within reason at excluding certain things that aren't relevant. And I think here there's not much of a difference between spend and activity. It's more about the way you reason which emissions come within the threshold and which come out of the threshold of materiality. Then let's have another question. So I think this is a good question for Freddie. Where can we get relevant emission factors? Where can we get relevant emission factors? Are they different for industries, countries, and then how to use them right in one's calculation? Thank you.
Thanks. Yeah, as also mentioned, there's a few ways to approach this, and what we do here at CoolSet is geographic location first and then closest year. So if you're calculating for 2024 and your business is in the Netherlands, you would choose, if you can, a Dutch emission factor, and then for the closest year, so maybe that would be 2023 or 24, and getting the relevant emission factors. So there's a lot of emission factor databases out there, some free ones too. There's a place called Climatic, which has a huge array of emission factors from DEFRA, BIS, CO2 emissifactoren, and other ones where you can kind of filter by region, year, industry, and then select the one that's applicable to you.
Perfect. Yeah, we'll take two more questions. I'll have a question here from Rohit. What would change in the Scope 2 emission post the ongoing revision of Scope 2 standard? So yeah, for those that don't know, the Greenhouse Gas Protocol is right now revising its Scope 2 standard, has gone through several rounds of public consultation, and is now kind of revising it behind closed doors. I have looked into it a couple of times and cannot say with certainty what will change, but I do know that, for example, they want to streamline a bit kind of the overview of what is market-based and what is location-based, so to have more clarity on that. And they want to have some more clarity, I think, on the way that they account for the use of sold electricity, for example, because also more people have their own solar panels now. So yeah, short answer is I'm not exactly sure what the final outcome will be, but we're tracking it closely. And as soon as that comes out, we'll write an article on it as well on the CoolSet Academy, and we'll, of course, integrate the changes into our carbon module. Then maybe one last question for Freddie. So is it mandatory or recommended to have a supplier portal for gathering data for Scope 3 emissions?
It's not mandatory, but it's definitely recommended. Yeah, really helpful to help you gather that accurate data, especially if it's activity-based data, because that will allow you to calculate more accurate emission results. But yeah, if you're doing kind of more spend-based to start with, then a lot of that data can be collected from your purchase orders and sales orders, so that can account for a lot of it. But definitely recommended to have the supplier portal or have a process in place to collect that data.
Perfect. Actually, I'll just take this question because I missed it, but I think it's quite relevant. Are there standard emission factors globally, for example, coolants? I understand for electricity, it depends on country/contract, but others could be standard, so we can compare across the globe. Yeah, so what we do at CoolSet, for example, is we use a lot of emission factors from all over the place and kind of, as Freddie mentioned, try and filter by having emission factors close to the country that you're reporting in as possible. That's not always possible. So, for example, we also use for Dutch companies emission factors from the US. Here, there are emission factors that you can apply globally, especially when it's activity-based. It's easier to do globally. And there are definitely emission factors that, for example, for coolants that are applicable across geographies. I know that in CoolSet, we have a whole list of these emission factors that, yeah, I'm not sure which ones exactly we're using, but there's a list, I think, of around 100 types of coolants that we're using that are applicable across industries. Yeah, that wraps up our session for today. We hope you found it useful that we told you a bit about the Greenhouse Gas Protocol and carbon accounting that perhaps you didn't know yet. If you're looking for kind of any more guidance or support, please feel free to reach out. Our email addresses are jasper@coolset.com and federica@coolset.com. We're happy to support you there. And we have, of course, we'll be sharing the slides and the recording of the webinar right after we end the session for today. So thanks everyone for attending, and looking forward to seeing you again in our next webinars. Bye everyone.